Welcome back, everyone. Cha-ching, cha-ching, cha-ching. Welcome to part 2 of my interview with John Aldrich, who's a tax estate planning expert attorney with the firm Bond Schoeneck King. So welcome back, John. Very nice to have you here. Part 2.
Part 2.
Boy, I knew in part 1 we you know what? We didn't get stuck in the weeds. Thank God. I really did understand everything you were saying. There. Yeah, I know there are. In part 1, by the way, if you want to catch that on our website, John and I were just talking about how the proposed overhaul in our tax system would affect individuals at different income levels. The other side of the coin, of course, is there are a lot of claims about how this is a business-friendly tax proposal and that small businesses are going to benefit, but when it comes to inheritance tax and capital gains tax, there's a mixed bag of news concerning that. Let's start with tax rate. The big one I hear is that regardless of the size of your business, you're talking about a corporate tax rate that's effectively going to go from 35% all the way down to 20%.
That's generally correct.
Okay.
There is the other proposal which relates to pass-through entities, which would be like subchapter S corporations or LLCs, which are not taxed at the corporate level.
Yes, right.
But the income flows through to the owners on their personal tax return, which the current bracket is 39.4. The proposal is to reduce that to 25%. But again, that's also got some limitations. So it's geared not to benefit attorneys, accountants, architects, not professionals, but retailers and things of that nature. So part of it will be taxed as it's like 70-30 a split, but effectively it'll be 25% on pass-through entities as opposed to 20%. That's your corporations, your major corporations, or ones that are taxed at the corporate level.
Right. So, of course, that depends on what kind of business you have, whether it's a corporation, LLC. And in reducing that overall tax burden from 35 to 20%, the prevailing thought, or what you're hearing about every day, is that that money will then funnel right back again into the economy.
Well, the hope is to stimulate jobs. The corporations will reinvest in their companies. The other part, which we discussed before too, is there's a 12% tax, or only a 12% tax, on corporations that bring money back overseas. As you hear a lot of discussions that they made all their monies in their factories overseas and they're keeping it offshore because if they bring it back into the U.S., they'll be taxed at the 35%.
Right.
The rate goes to 20. If they bring back that money, or if it's illiquid, they bring it back, that's only taxed at 12%. So again, the expectation or hope is that that will be put into the economy, create jobs, and stimulate the economy.
I've got it. Boy, there's pros and cons on that conversation. I hear about it every single day. One other thing also they're talking about is the estate tax.
Correct.
The inheritance tax, I'm sorry.
Yeah.
Give us the rundown on what's going on in that.
Well, right now, there's we started off at $5 million, now it's $5.6 million. Exemption from any estate tax for any individual. It can be passed from husband to wife, so between the two of them, going into next year, there's $11.2 million that can pass down to their children or anybody else with no inheritance tax or estate tax. The proposal will double that and then make the elimination effective by 2024, which, again, right now, I think the percentages are only 5 to 10% of the people have to file a estate tax return. People say that's benefiting the rich. I think, as we discussed, one of my feelings is, well, it's benefiting those individuals, but they're taxed on it. What it's really helping is your family businesses that may be illiquid. You know, as we talked, they may start a car dealership and be very successful at the car dealership. And if it's worth $15 or $16 million, say, just on multiples, when they die, they're going to be paying 40% on anything over that $11 million, which may seem fair. On the other hand, they may not have the liquid assets to do that and be forced to liquidate a family business.
Yes, right. So, you know, what John is referring to there is that, you know, if you have a family business and you might be subject to an inheritance tax, well, then in order to pay that tax as it's passed down from a father to a son or to a daughter, that they may not have that much cash liquid, so that they would be forced to sell the business.
Right. And so it's a self-fulfilling prophecy that family businesses don't drop down, or farms. You can have a farm with a lot of cattle for milking and a lot of equipment, and the cost for tractors these days is not cheap. I mean, and you get a large farm, and again, you want to pass it down, you're not that liquid.
Yes, that's right. So it, and then of course, if that is sold to an outside party, then that sale and the cap gains on that is subject to taxation.
That it would be. Right now, you wouldn't incur any capital gains, because on a death, you would get a step up to market value. So if your farm is worth $20 million, you're going to be paying 40% on anything over 11. But if you have to sell it, there's no income tax because you bring it up. And the argument is, don't tax it, but don't give them a step up in basis. Have it paid when they sell the farm ultimately, if they do down the road.
In the time left, as you look at it as an expert, where do you see the benefit here?
Well, there is
now recognize that there's going to be a lot of compromise still, too.
And I mean, there's simplification in the sense of eliminating itemized deductions. So the complexity, they'll say you can fill it out in a card. Is that going to be good or bad? That's a hard one to call. I mean, and you have your interest groups, as we talked about. The three deductions remaining are going to be really interest and real estate taxes are going to be capped, and charitable contributions. But if you're in that upper income or middle income, then by doubling that deduction up to 24, and you can only take $10,000 for interest and real estate taxes, charities may take a hit, and that's their argument, that they're going to be losing potential contributions because someone will just make standard deduction and not give it to charity.
Yes, right.
So I think there's going to be a lot of focus on the itemized deductions issue. There's a lot of different spin-offs, as we mentioned. I said to you, they're kind of consolidating some tuition plans so that effectively a 529 plan going forward under the proposal could be used for elementary or high school education.
Oh, not just college.
Not just college. So that could be used for that. Corporations are not going to get the benefit of deducting tuition assistance, which if they send an employee to an education or something like that, they can deduct up to $5,200, no income tax consequences to the employee. That deduction is going to go away. We're trying to retrain people. That kind of seems like it's defeatist as opposed to helping to retrain the workforce.
Yes, right.
So there's a lot of different little points that really haven't bubbled up yet that hopefully will be refined as they go along.
Well, as you can probably tell if you're following the news like I am, that every day they are going to be negotiating this and trying to fine-tune it. They set a very aggressive schedule and deadline. They were trying to get this done by Thanksgiving. I think that's impossible just given just the things that we're talking about. But, I really encourage you, go to Bond Schoeneck and King's website. And there's a lot of information there about the tax plan. And let's face it, the more we educate ourselves, the more we can talk to our elected leaders about what we like and what we don't like. And certainly not be surprised by any of the rhetoric that you hear about it being the best thing in the world. It may be for some, it may not be for others. Find out how it affects you. But John, thank you so much for coming in
and
explaining it to me. Yeah, I was hanging on by a thread, John.
Quiz will follow.
No. Okay, to see this interview again, you can head to our website, looktvonline.com.